All right, guys, time to introduce the next panel, talking about building the BTC yield economy. Give it up for Natan, Granit, product manager at Starkware, Mirko Schmiedl, co-founder and CEO at Staking Rewards, and Balogh, CEO at BitSafe.
So hi, welcome to our panel. Thank you for the introduction. So we're going to talk about BTC yield and BTC yield economy, and I think it's not the first staking summit that we're discussing Bitcoin as an asset and how can we contribute and how can we make Bitcoin utility bigger. And I think it's self-evident. The potential is huge. This change can affect DeFi all across all other blockchains, and it's still untapped. Most of Bitcoin still sits in the Bitcoin chain, not earning yield, not doing anything. It was the old paradigm that Bitcoin should be like a digital gold, and we're seeing this shift. And today we're going to discuss this shift, what brings about it, how strong it's going to drive, and what we need to do to make it bigger. So joining Mirko and Aki, thank you very much. Yeah, anything you want to add before we start?
Quick intros?
Yeah, please introduce yourselves. Yeah, sure.
Yeah, go ahead.
Yeah, so I'm Mirko, co-founder and CEO at Staking Rewards. We're also building a Loop BTC product, a BTC yield product. Yeah, so that's really on topic, and generally I'm very excited about making BTC a productive crypto asset.
Yeah, I'm Balogh, I guess second-time founder. I founded BitSafe 4 years ago to build on Bitcoin and to find safer ways to use Bitcoin in finance and lending, etc. We were originally funded by a grant from Chainlink and some other grants. And then over the years, we raised $3 million from OKX, Sequoia Scout, ABCDE, which sadly is no longer a fund, and some others. And about a year ago, over the years, we built out various wrapped Bitcoins on Arbitrum, 11 ETH chains, EVML2s, Ripple. So we built one called IBTC on XRPL, which Keyrock and Flow desk are market making. And then this February, we pivoted to solely focusing on Canton Network, which is an institutional privacy-enabled L1 that I can talk about. And we're setting up institutional-grade BTC yield options on Canton. And then hopefully we'll be able to expose some of that to retail as well so that, my dad can use it.
Sounds very interesting. I learned a lot about Canton just reading the background of both of these people. So that's for me very interesting. Okay, let's dive right in. What do you think that drives this shift, this paradigm shift from being passive thinking about BTC all the way to make it more utility-oriented and putting it to work, so to speak?
Yeah, so I think it's really, crypto is used to having very productive assets, especially with staking being super prevalent right now across the industry. Pretty much any asset is stakeable and is generating yield, and Bitcoin feels like it's the only asset left that's unproductive, and people are looking to do something with their BTC, and are very used to the concept of having a productive asset. And now with concepts like staking, Bitcoin staking, like Starknet is doing, for example, and others as well. This really is the start of making BTC a productive asset, and obviously there's way more to do with BTC in terms of DeFi strategies, collateralizing BTC, and so on. So I think this is there's just a very strong demand from investors to earn yield on BTC.
Yeah, and everyone kind of knows the pitch. It's, the largest pool of underutilized collateral in the world, yada, yada. One difference between Bitcoin and gold is, one is it's hard to carry a bunch of gold to Buenos Aires in an airport. But the other is that you can program and build on it, which is really interesting. So that's what we dedicated 4 years to, originally working with a technology called discrete log contracts, DLCs, and which was kind of interesting. Ultimately concluded DLCs in their current form we couldn't find a way to make them work. Maybe somebody else can. But there's also some interesting things with BitVM. But then what happened along the way was in the US, I live in New York, so I have a kind of US view, which may be relevant to some, but not everyone. In the US, when BlackRock launched the spot ETFs and it became kind of the, best performing ETF of all time, that set into motion, and around the time when Trump got elected and the attitude toward crypto changed, set in motion just kind of broader acceptance of Bitcoin in TradFi, which is great. Because, having looked at this for a while, my belief is that the best way to get yield on Bitcoin is to financialize Bitcoin itself. So just like any asset like gold, you can borrow against it, you can invest it. And to make that easier, and it's not necessarily a technology problem as more of a technology adoption problem, enabling Bitcoin to be used in, hedge funds and, collateral mobility across, lending desks and the various uses that finance people could think about with a valuable asset, while retaining as much of a decentralized nature as possible. While you put it into these yield vehicles, meaning you're not necessarily just holding the Bitcoin at a custodian and doing something with it, but there's some more interesting designs, and we focus on one especially called Frost Multisigs, which I can talk about.
A quick follow-up. So, can you point out to specific segments or specific products that currently drive this shift and drive this adoption?
Yeah, so, a lot of people, I'm a technologist myself. A lot of technologists look at this and they're like, what can we build on top of Bitcoin? But there's not that much you can do. Dramatic oversimplification, but in the limited world we live in, I don't focus on BitVM, so there's people much smarter than me at that. But basically, in a limited world, you can either hold Bitcoin, you can send it to someone, you can transfer it, or you can lock it. And the third one is quite interesting, because if you can lock it, then you can mint a synthetic Bitcoin on a chain and then move it around, put it into smart contracts, yada, yada. Why do that? Now, you could just send the Bitcoin between two banks or whatever, but then you have to have a legal agreement between those banks. Now you have counterparty risk, you have legal risk. What if one party doesn't follow through or someone goes bankrupt? So you kind of miss out on a lot of the protections, that you could have if you just locked it, moved it to a chain, and then you had immutable smart contracts moving it in a very specific way that you can audit. And that would, is a lot better than just having, a bunch of banks kind of, and their lawyers and stuff. So that's interesting. And so that's what we're trying to build out now.
Sounds very interesting. So I think it's a great segue to maybe your take or Mirko's take. What is the most lacking in infrastructure or something that is not yet mature for Bitcoin as a utility asset to spring to its true potential? If there's something technological that is missing.
Yeah, I think the biggest, what's still missing is like having a trustless bridge. Essentially, like Bitcoin is, you can think of it like an off-chain asset basically, and like everything is happening on-chain on like the EVM environment and on Ethereum and so on. So somehow we need to tokenize Bitcoin in that sense, in a trustless way. And somehow it worked well already for stablecoins, and there are already Bitcoin wrappers and what you guys are working on as well. But it really has to be fully decentralized and trustless in a way. So it can be used, as you have the real Bitcoin basically on chain, and I think that's what's still missing right now in order to really unlock tremendous capital for Bitcoin to go on chain and then generate yield and be financialized in a way to, be more productive.
Yeah, just to build on that, I totally agree. It's kind of like a spectrum. So on one hand, you have WBTC, for example, which was the original wrapped Bitcoin, originally owned by BitGo, not anymore. They sold it a year ago, but at the time you could send Bitcoin just to BitGo and then they would mint this synthetic. But then you have the counterparty risk of BitGo. You also had another issue with that. BitGo is a U.S. trust company. So customers who did not want to send their Bitcoin to a U.S. trust company for whatever reason couldn't use WBTC. Then BitGo sold it to BitGlobal. Now it has multiple entities. Now it's the counterparty risk of those entities and, various regulations and stuff. So anyway, whenever you have one custodian, you have risks with that, and then you have a regulatory body, above that custodian that you're subject to. So that's one end of the spectrum. On the other end, and it could be BitGo, could be any custodian. There's, various custodians launching, custodial wrapped Bitcoins. It's kind of an easy thing to do, so that's great. On the other end, you have things that are being developed, like BitVM. Like, wouldn't it be cool if we could somehow Bitcoin could verify fraud proofs, and you could have all this fully decentralized thing? Problem is, those things don't exist yet. People are working on it, really smart people, lots of money being poured into that. That's super cool. And then in the middle is what we have today, which is what we focus on, which is not very well known, but not broadly known, but it's something called Frost, which I've been practicing how to say. It's flexible round optimized Schnorr threshold, but basically it's a threshold signature scheme. So you have, and it was added in Taproot with Schnorr signatures 4 years ago. And so basically you have a multi-sig. So for example, we have a 10 of 15 multi-sig. Botanix has a 16 something, I don't know, 10 or something of 16 multi-sig. Stacks also uses Frost. They have a whatever multi-sig. But anyway, it's an M of N multi-sig. And so basically you use this multi-sig, it generates a Bitcoin deposit address. You send your Bitcoin to that address. And then these validators, or we call attesters, basically publish attestations that the Bitcoin's there. That provides an on-chain proof of reserve. Versus with a custodian, it kind of trust me, whatever proof of reserve they might have, but it's not on chain. So with Frost multisig, at least you get an on-chain proof of reserve. And this is where what we think is both available now and pretty safe. Not perfect, of course, because it's not the entire Bitcoin network, but it's, if you pick, in our case, we picked the 15 largest node operators in the world to validate it. And so that's, acceptable from our perspective. And then, and obviously everyone has to do their own research. But anyway, once you wrap the Bitcoin in this way, then you can do cool stuff with it, like get yield, which is what everybody wants. So in terms of audience, we don't sell to Bitcoiners, we don't sell to retail, we don't sell to miners, we don't sell to, whales. We sell to companies that have a fiduciary responsibility to generate yield for their customers or their shareholders, like DATs, trading firms, asset managers, and then they can do their own security analysis of Frost and our implementation of Frost, which we forked from Zcash. But anyway, they can look at that, and then they can, once assuming they whitelist it, then they can do all the cool yield stuff, which is where it gets really exciting.
So it's kind of between the lines. What you said is there's nothing technological blocking this growth. You're thinking basically with the current post-Taproot change, with the current code repos and stuff, you can see a lot of growth that is still not happening. And so you're saying BitVM and stuff might help, but it's not a mandatory thing.
Correct. Yeah. So it would be, it would remove Frost assumptions, but I believe what we have with Frost today would work for most audiences, maybe not all. And we would never persuade someone to move their Bitcoin into some technology they do not understand. So, that's also why we don't sell to retail, etc. But someone could, like Robinhood or somebody could market to retail once they're there, once they have these products. But I believe Frost already works and other companies are using it. I recently was in a conversation with an asset manager in Japan, which whitelisted Frost and therefore whitelisted us and Botanix and Stacks and did not approve WBTC. So it's the first time that Frost beat out WBTC in a serious security analysis. So that was pretty cool. So I hope to see more of that.
That's very interesting. So I think we discussed a bit about the infrastructure and the market shift in general. And I want to focus a bit about the yield-bearing side. What can you do if I bridged it? I gave all the trust assumptions. I don't know. I gave you my Bitcoin. I don't care. What can you do with it? And we'll start with Mirko. Not only the product you're building, but what do you see about the landscape of Bitcoin yield in general, and what do you think is more sustainable and why?
Yeah, also just to add to the previous point again, I think obviously there's the trust assumption around the bridge, but then even more important, to unlock that and make people comfortable with those trust assumptions, you still need to have a product that's actually interesting to take on that risk. It's still a risk, right? whatever you do with a BTC, and then be comfortable to do something with it. And for that, we need sustainable yield sources. So this is still very early, I would say, to have scalable, sustainable yield sources for like billions of dollars in BTC. And to do something like this, it has to be like, pretty programmatic. I think the approaches from like just staking, like Starknet is doing, BTC staking, or Babylon are very interesting. But also, I see them more as an entry point into BTC yield. Same as we do have with like LSTs right now. It's like LSTs basically bridge the gap of productive assets with the DeFi world, and I think staking margins will compress, so it will become much more important to have like actual returns from financial products on DeFi, and I think BTC LSTs can be the bridge to that, but it has to there needs to be much more innovation on how the yield is then financial, or like how financial yield is generalized on the LSTs basically. And that cannot just be a hedge fund, like a void product. It has to be much more automated and programmatic. And that's also what we are trying to do with Loop BTC, is basically building a full automated system that collateralizes BTC and then generates yield on the stables to then take the stables, convert them back into Bitcoin, and then generate some BTC to BTC yield that's actually sustainable and also programmatic with very clear trust assumptions on how the yield is generated.
Okay, that sounds very interesting. From your perspective,
we only look at products that are BTC on BTC. So none of the products we get excited about paying another token. Just because if you like Bitcoin, you want more Bitcoin, you don't want some other token. That's our assumption. Other camps see it differently, and that's fine. We look at, where can you get yield on a financial asset? You can get some really safe yield on repos. Get really, lend it out. I think Galaxy will pay like 3 to 5% to borrow Bitcoin at times, not all the time, but at times. Hedge funds, Samara Capital Management, Atitlan, Algos, there's a bunch of them. Amitis, I don't know why they all start with A, but it's not a requirement of having a Bitcoin hedge fund. But these are experienced money managers that can generate like 10 to 15% per year on your BTC. There is a risk of drawdown. You have to research it. Also, you have to qualify to put your money in a hedge fund. You have to fill out a bunch of paperwork. That's what we're trying to make easier to subscribe to these funds, which would be really interesting through feeder funds and stuff like that. Asset managers. But it is possible to get these. And how do they get the yield? Well, they do black box stuff. Arbitrage strategies and things like that, which they would be a better position to tell you, or you can read their prospectuses. But we're basically, assuming that there's a bunch of, really smart financial players. For me, the important part of risk is not the bridge. The bridge is fine, I think, with the Frost thing. We didn't invent it. It just works. I'm quite comfortable with that. The thing is where the yield comes from, the yield mechanism. So you can give your Bitcoin to some crypto boys and they could do something, and maybe it works, maybe it blows up. But what you probably want to do is give it to an experienced money manager that is regulated, has fund audits, has a track record, has KPMG, doing their audits. Someone who knows what they're doing and has been doing this activity for ideally, years, if not decades. And so we're seeing these funds like the 4 I mentioned and many others pop up. And I think there's going to be more of that. And then, of course, you'll want to diversify among them, even if you choose to use one or more. I recommend more. And then, so then where the problem we're solving is kind of a boring problem. It's an onboarding problem. It's not like how does the technology work and how does the yield work? There are explainers for that. It's how can we subscribe to their awesome strategy if I'm like a small guy and I cannot fill out a 120-page PPM, onboarding document and yada yada, and so we're trying to make that part easier.
So, what is the biggest risk? You're saying what they want is yield, and you said, okay, you can give it to crypto guys, you can give it to fund managers, etc. When you're talking about people that bring this liquidity, that hold it, either the custodians or the companies that have fiduciary responsibilities to make it. What makes them have cold feet? What is the risk they are most reluctant to take?
I believe the biggest risk for these guys is counterparty risk. So let's say you deposit the Bitcoin in, Zodiac, Komainu, they mirror it to, Bybit, OKX, wherever they trade it there. What's the chance that one of those exchanges blows up? What's the chance that the fund itself blows up? Like, those are the just regular kind of risks that a money manager would be, looking at.
But in that sense, and the fact that the Bitcoin underlying all of it can be sometimes saved is a hedging that a lot of strategies don't have. If you think about it, you said the copy of the Bitcoin or something, representative of it or something blew up. But if underlying, I kept it through a custodian and it is in the custodian's multisig, so it might be a nice hedging, or maybe I'm just...
That, in our view, that would not apply because whoever the legal owner of that Bitcoin is in a bankruptcy would get it. So it's not a technology problem. So basically, the way we're doing this on Canton is you move Bitcoin into the multi-sig. And by you, I don't mean us as retail. I mean companies. Let's say it goes from BitGo institutional into the multi-sig, mints into Canton. You subscribe to one or more fund managers there in a vault. They then grab the CBTC, burn it back into BTC, mirror it to the exchange and do their trading and then generate the yield. That's kind of the current flow we're getting towards. And then we can use Canton stuff to make it kind of easier to subscribe to these vaults, which none of this is live yet, but that's what we're working toward.
Okay, so we don't have a lot of time left. It's actually saying zeros, but I think it's very important for everyone to hear. How do you see a developed, a mature BTC-fi market or, a BTC yield market? It can be in a year time, can be in 5-year time. Yeah.
I think it will take years for it to develop, especially there needs to be more standards and insurances for investors as well. So if they invest in a BTC yield product, they want to get a guarantee that they at least get their collateral back or something like this. And in the crypto space, especially with staking and slashing, you have certain mechanisms to ensure also programmatically that you have a guarantee on your collateral. And I think that's something that has to be built out over the coming years. And it's uniquely possible in blockchain. So I think it will happen, but it's probably going to take a few years until we have very, very high scalable, sustainable yield sources with guarantees of the collateral also.
Yeah, in our world, for these institutional customers, basically same, collateral mobility, getting the Bitcoin into, the DTCC has a platform called Composer X where you can move equities and DeFi instruments and stables across, various counterparties. So that's something they're working on. They've been doing some interesting work with Canton that you can read up on. NASDAQ, Calypso, whatever these regular platforms are where a lot of trading happens, getting Bitcoin, built into these systems and making that work. And then once that's available and, working, then these financial firms that trade all kinds of other things can also trade it and use it there.
Okay, sounds very interesting. So basically you're saying incorporate it in a way in TradFi, and you're saying keep the unique qualities of it as a Bitcoin, as a crypto asset. And yeah, sounds like a very, very mature, but might take a few years. Thank you both. If you want to add any remarks or something to conclude, please do.
No, thank you very much. It's been great.
Yeah, you'll always have these different camps. There is not a one-size-fits-all solution. There does not have to be. There's going to be different chains, different approaches. Some people have different regulatory requirements. Some people want a KYC, some people don't want a KYC. So it really just, whatever's right for you. If you also want to hold your Bitcoin in some sort of custody or cold storage, do that. So it's really what you want to do. And it's just really cool to see this market evolving with different players and different use cases. So, we're all in it together to make it a bigger thing. So it's great.
Sounds great. Thank you both. Thank you, everyone.